Happy Friday, Pat. We jumped into a quick intro there so that we don't bore our viewers.
Yeah, it's the last thing we want to do.
Yeah, we do that on
I'm
our
sure
own
we
as
do. We
well.
do that on our own pretty good.
That's right. That's right. So happy Friday. So been an interesting week in the interest rate world.
Yeah, it has been. It's been interesting. Really, it's been an interesting since I'll show you. Let's see here, right here. I mean, it's been. This is November 4th, right? November 5th, and then hit a hit, and we just been this staircase climb since we saw a blow off today. It was about the market was down. Basically, when it was down 42 bips right here. Yeah, it was up from a price because there's an inverse relationship, but yeah, the 10-year Treasury was up 8 basis points. So it's been really just kind of slow Chinese water torture. Really, like I said, since November 5th is when we hit, and you just saw the breakdown. I mean, if you look, just to give people perspective, nobody's got a you know crystal ball, but I mean, here we're back to levels basically where we saw during the beginning of the pandemic, March 16th. We saw, remember that craziness
Yeah.
here? This is the craziness. The bond was like, we didn't know what was going on with the world. So then obviously this is not rates, this is price. So price is inverse to rates, but I go off a price, basically, if I want to show you, let me just, I know I'm going to bore people to death here to tears, but let me just give, this. So this, this is 2020, 2021, we just saw a lot of muddling. There's some big moves in these intradays, but you can see this is a 3-year time frame on rates. So we obviously, let me just flip this around so I can show people that was the price. And like I said, there's an inverse relationship to the price and rates. Let me see if I could get this is a 2-year. Oh, come on. Bear with me 1 second here. This is rate. This is what people, when they say rates, this is what rates are. I was looking at the price on the other chart, but they based out, they're low 2020. We had a bunch of refinances, and then we broke right here's obviously the insurrection, right there, the Trump, all the election stuff that kind of broke the camel's back right there for the year, and then it just started going up, and then we saw a little reprieve in May. We hit a bottom in July, and then we saw rates going up, and you see this period in here where it was consolidating from about October to it just felt like the pressure was moving somewhere, and obviously we saw that bust out here. And like you said, hopefully we see in a short term these little bars in here from a technical standpoint. All these little bars in here, these are little resistance levels. So when you see, it break, like here, there was a resistance level and it broke out, it went up higher. And then, you see how these sit around the resistance levels, they just chart it out.
Yeah.
And then, but all these little bars are different resistance levels. So if we break, they say the next resistance level is 181. You can see how, rates are just kind of sitting around this level. And they're saying the next level would be 2% on the 10-year. So,
Well, the Mortgage News Daily is saying is the worst over for the early 2022 mortgage rate spike.
yeah.
Um,
We've seen a wicked, the last week and 2 weeks have not been good. The last, 3-4 weeks have not been good. But now that the news is out, see, the problem is now the news is out, it's all trading on future news. Now the news is out. Once people say, oh, when rates, the Feds actually raise rates, believe it or not, they typically will go down because this is what's been baked into it already. So
Yeah, but from a consumer standpoint, people are very nervous that rates are going to go up. And they don't understand that, the announcement's already been made and the rates have already moved. It does not mean that we're going to see more and more of this going on in February before
yeah.
the Fed may actually come out and raise rates in March, and that chart will look exactly the same.
Mm-hmm. Yeah,
So
exactly. I
it's
want to. just to go while we're on rates, I'll flip it to pricing too here
Okay.
if you want. I mean, just real quick. I mean, if I can, let's see here. Okay, I'm not, come on. When you got 3 screens, it's hard to figure out where your mouse is. Okay.
I know I've done that. I go to move it and I go, wait, I'm on the wrong screen.
Yeah, let's see here. Let's see. Try to get it down to, why will I not?
While
Here
you're
we go.
looking for that, I want to share something here from the Cromford report.
Yeah.
And it's a bit of an eye chart, but I'm just going to read what they're saying here. And it's talking about the cost of purchasing a home versus renting. And he gives a great example here. And he's saying that the overall median price of a home is currently 425, and the price of a typical 1,600 to 2,000 square foot home, the median cost is 420. The estimated payment, assuming 10% down in principal and interest, is about $2,100. The median monthly rental rate for the same size range, is $2,195, just $72 a month more to buy. Okay. So you have to ask the question, is it worth it? 72 bucks more to buy versus rent. So he runs through a scenario. He says, let's say you buy today at 420, right?
Mm-hmm.
You put down 10%, and over the next 5 years, their home value fluctuates up and down. And in the end, in 5 years, it hasn't moved. Disappointing, right?
Mm-hmm.
That may sound horrifying. However, during the same time, principal's been paid down to $336,000. The homeowner's equity's doubled from 42,000 to 84,000 without their home appreciating a dime. And with 20% equity, now they no longer have to pay private mortgage insurance. And that's kind of a key point to think of as people that are, looking at buying versus renting. And well, what if prices come down? Well, what if that home that you bought for 420,000 now in 5 years is only worth $350,000? You still only owe 330,
Mm-hmm.
and your payment's not going to change. So that's what I really want to stress for people. If prices do come down, which, and I'm going to show you some data, there's absolutely no way that it's going to happen between now and March, but you're not going to have, there's nothing to stress over as far as, oh, gee, I got burned.
Mm-hmm.
Just
Mm-hmm.
stay put. So these are your pricing rates.
Yeah, this is
Adjusted.
just a scenario that I ran. I kind of want, I'm peeking underneath. I mean, a lot of people don't see, I mean, for whoever's watching, I mean, me, I like to, try to give them a peek under the hood once in a while with rates. And, because, people hear rates. Okay. And there's a lot of different mortgage companies out there, but I'm myself being on the broker side. I do have like I said, myself or brokers do have an advantage versus retail banks. There's some strict mortgage, they strictly just do mortgage, banking. I'm not going to mention any names, but there's some locally here, but it's amazing. I was, with rates going up right now, you're looking at about 3.5. This is a scenario I think I put, uh, what was the scenario? Purchase total loan. It's purchase price 550. Total loan is 440. So 20% down. So you're looking at about 3.5. And this is what people don't understand. Like I said, when they shop a loan, and that's me being a broker, I'll just show you before I do this. These are all the lenders I can go to on this one scenario. These are all the scenarios. Now there's different pricing. You get down toward the end here, and there's some really, I mean, you don't want to be down. I don't want to be down here pricing because it's, I want to stay in the top tier when I price a loan. Because there's different lenders. Like I said, hopefully I don't get too wordy here and start boring people to death. But, like there's a Town Mortgage Company. I like these guys. Plaza's decent. Union Home is a great company. Haven't worked with Resi Central. But, I mean, basically here it's a pricing of, the pricing is pretty similar right in this line here. Like I said, the Remen, I got all these different lenders I can go to. There's some lenders that are going to be, if I get a certain deal that's, I know this, maybe Union Home is better than Plaza on a certain deal, but this is pretty much agency basis, Fannie Mae. But like I said, right now, 3.5 would cost you $1,390. Now, when I price a loan, back in the day, if I priced a loan higher, I would get paid more. But now I'm on a fixed compensation, so it doesn't matter what rate I get. It's basically every benefit has to go to the consumer. So if I'm looking here, 3.5 is a cost of $1,390. And this is what people don't, the whole point I'm trying to bring, the point I'm trying to make is it's amazing the difference in just incremental eighth point differences or quarter point difference in interest rate. If I was going against a local mortgage bank that was just, because a lot of mortgage banks now, I'm seeing rates quoted 3.99, 4%. Okay. Right now, I would be I could give the client the benefit, like, okay, I could either charge you 1,390 and get 350 or 3.5, or for an extra eighth, I can go from charging you 1,300 to actually giving you a credit of $1,100. So that's a $2,500 difference.
Yeah, and I think that's really important because you said a couple key things there I want people to understand. One is that unlike what it was like back in the silly season 2006, when you raise a rate, you don't get higher compensation. You're not going to make more commission. The other thing is, Pat, what's your rate? It's right here. It's all of these different variables depending on your credit, your down payment,
Well, look at
depending
here. This is
on the fees.
Mhm.
And so just giving you an answer on saying, well, my rate is this, it's impossible.
Yeah, it's impossible. I mean, like you said, just to show you, I mean, I can go if you want, Town has been good to me. Union Home has been really good to me. Plaza's a good company. But then, you start, like I said, some of these lenders in here, I'm not going to, mention any names that are on the list, but, some of their underwriting is a little slower. The service isn't quite as good. So, I mean, I've been really treated well by Union Home, um, when I get stuff to them that, the rep calls me, he calls me back right away. So if, you as an agent or a client want service right away and you're calling me on a deal that I need a call back right away, he calls me back within 5 or 10 minutes. So it makes the deal go a lot smoother. But to go back to this Town thing that, like I said, this is Town mortgage, if a retail bank say if I'm going against a retail bank and they're at, say, 3.99, a lot of them do 3.99 or 4. Doing 3.99 to be tricky under 4%. Well, let's just call it 4. In this scenario, if I was going up against that same rate, and a lot of these banks will charge $1,400 in processing fee or underwriting fee, which I don't have. So you add that in, but if I charge 4% equal, rather than getting that rate, I can give the client what $6,800 credit to their closing costs.
Wow.
So I can go, if I go from, say, 3 5/8 to, say, 3 5/8 is a credit of $1,100. But if I just bump it up a quarter point to 3.875, I can give them a credit of $5,200 just for that quarter point bump in rate.
That makes a big difference too. When you're scraping to get that down payment and you're looking at the fees you have to pay when you get credits. I know that VA loan you put together for me at one point, they were just absolutely tickled because when they sat down to sign their documents, they got a check back.
Yeah.
And so that's fun stuff.
And that's the thing that when it comes to price, like you called me or whatever, I mean, I'll we'll talk about the client. Does he need closing costs? Like I said, and I'll rehash this. We did this before, but I think it's good to go over this stuff since rates have gone up and, I think people have to see where the base rate kind of is in this given time frame. But I mean, just the difference in rate, if they shop, they're getting, they said these retail banks, their cost structure, they got a fixed cost structure and they've got a lot of underwriting managers and they got retail managers they got to pay and vice presidents. I don't have to pay that stuff. So that's where my advantage, I think. But I just wanted to kind of show people the difference in rates here recently. So
I appreciate that because that's at top of everybody's mind right now. Because here's the market. The Cromford Market Index, anything over 100 is considered in favor of sellers. Take a look at Fountain Hills at the top there, 723. It's gone up 9%. Everything's up with the exception of Buckeye, and Buckeye only dipped by 1%. But it's definitely not only just a seller's market, but these are some of the highest numbers that we've seen all year because the inventory is not showing up yet in January. We're sitting here with 5,900 again today. We should be around 6,500 on a Friday at the bare minimum. And
Mm-hmm.
so the listings are not showing up. The sales are backing off a little bit. They're trailing. Nothing major when I look at the 7-day moving average. We've got, the yellow line here under contract and the blue line. They're starting to merge again, getting closer. But the number of homes for sale is at such a low. And then the other issue that we're having, Pat, is that the iBuyer traffic is huge. That there are investors now even going into new builds, buying the new build and turning around and flipping it, and selling it. And so the opportunity for home buyers to go out there and try and find something right now is exasperated by that. And I looked in Chandler, and out of the 163 homes that are for sale down there right now, 57 of them are being sold by iBuyers, which consists of OfferPad, Open Door, and Zillow.
Hmm.
Now, they used to only make up 6% of the total business, and here we are at 33% in one city. And I think now with the virus going around, and you can hear it, so
Yeah.
that's people are going to move towards that model to say, look, I don't want anybody to look at my house, and they're not going to run towards it. But I think that number, when you see the numbers in February of homes that are listed by those iBuyers, you're going to see it up in the 40% range because
Hmm.
there's so much equity out there that they say, I know it's going to cost me more money, but I don't want 20 people walking through here. I just want cash. I want certainty. And they also like the fact that they can schedule their own closing, which makes it very convenient when you're doing a new build. So I'm
Mm-hmm.
not trying to promote them per se. I'm just saying, of all the options out there, this one's getting a lot of traction right now. And so Taxley, greetings from Goodyear again. Yes, you guys are doing great out there. Zudilio, Rick, love your setup. Appreciate it. I got to interview those folks just the other day. That was fun.
Yeah.
So that's an interesting number to watch. And Zudilio is the one that was looking at Gilbert, and they were 27% of iBuyer traffic. And do you believe the iBuyer sellers are listing now to get a leg up on the springtime increase in sales? The ones that are listed now were purchased 90 days ago. So, it takes them that long to let the thing close and go in and renovate them and put them back on. So I think you're going to see the December purchases show up in, what do I want to say, end of February?
Mm-hmm. Yeah, probably. Yeah.
So something to watch though, but the institutional traffic here in Arizona is high. The shocker is that OfferPad has 2 homes listed for over $900,000. They never used to play in that sandbox.
Yeah. No, definitely not.
And the Wall Street Journal here's got an interesting article talking about um, what if investment and economic growth weaken, but inflation stays high? If inflation settles at 3.5%, as some economists expect, then bond yields could double to 3.5 with real rates remaining at zero. And they're saying for now, investors think inflation is coming down and it will average 2.5% over the next 10 years based on yields and regular and inflation index bonds. What they're saying is the market's not buying it, that
Yeah.
inflation is here to stay. But he puts in a caveat at the end. He said, so why would they think? He says, bond markets have never predicted an outburst of inflation. So why would we think they can now? He said, he adds, they respond very quickly when inflation starts to rise. So it doesn't really matter whether or not the bond market believes inflation's, coming or going, because if it does hit and stick, the bond markets can react quickly. So,
Like,
Marcella, nice to hear that. Thank you.
well,
Now,
let's one thing I will say. I mean, looking at one thing we got to put to bed, because people are like, oh, there's gonna be a crash. Um, I think we should just put this foreclosure stuff to bed because I mean, even like Mortgage News Daily said, this there was I don't know if you saw the article about foreclosures are not going to affect this market at all. I
they're
mean,
not even a blip on the radar. I, I, we rarely make predictions, but I'm going to predict February and March here based on the numbers we're seeing. Sales are staying where they're at. Inventory is so bad. We were clipping along at about a 1.5% appreciation rate November, December. We're going to be back up in the threes, Pat, per month.
Yeah.
February, March. I think when we look at the March closings, I think people are going to be stunned.
Yeah.
Not because sales are nuts and going crazy, but simply because there's nothing out there.
I know. I know.
And so we're going to fight for it. We're going to scramble. And
Yep.
Wall Street wants us to believe there's a crash. They keep us out of every market. They buy everything up and increase the prices. This is just a natural market force. There's nothing available. Nobody's going to list their home simply because they have no place to go. I interviewed Jeb Smith yesterday in Huntington Beach. It's unbelievable. They've only got 900 homes for sale in Orange County, of all places. He
God.
put a house up for coming soon for $2.7 million and had 2 cash offers already. And
I didn't know you were buying a house over there.
well, only one.
Oh,
But we talked at length yesterday about what they're going through in California, because we're blaming California for this whole shortage, but he's got the same problem.
yeah, I know. It's
So
hard
does
to believe you got a shortage when you got homes for $2.5–3 million. I just
800 square foot homes go for 1.2 million out there. They're just
yeah.
it's so we talked about, well, what's it going to take for inventory to come up, and I don't think really anybody has an answer. It's difficult. There's it's a tough one to forecast. Now, I will say, um, let's see here. I was passing by a new build neighborhood around Glendale, Olive, around 67th. The whole neighborhood is built new, direct to rent by one investment company. Yeah, that building to rent's very popular. They're springing up all over the place, and I've been past that one that you're talking about. There's about 10 of those in the valley. Phoenix is the epicenter of that build to
Yeah.
rent communities. Yeah, there's a lot of people just like to rent and hate renting apartments.
Yeah.
Those build to rents, they're kind of cool if you like to rent. But you know what? They're not cheap.
Yeah.
We got a coming soon coming here. I bumped into this today. This is in Fountain Hills. This is a nice 2-bedroom condo for 235,000.
Oh, really?
So if you're looking for a nice condo, they're remodeling it. I just bumped into it. I normally don't try to push listings out of here. This isn't mine, but it's a decent one. I got a gentleman looking for a condo in Scottsdale, so that one showed up. And then now we're always talking about water, right? New Israeli irrigation technology could save water for Arizona farms. And they're talking about right now, instead of the water just irrigating, going out, they're putting in drip systems. And it saves the farmer 30% on water and increases their yield.
Hmm.
So
Interesting.
excuse me again, I keep turning off the mic and having a little coughing fit there. So
Well, I mean, to go back to that, I mean, that water thing is interesting. I mean, but on that Mortgage News Daily, you know how much equity there's? Do you see the number that how much equity there is? Record equity,
no, I didn't see that.
23 trillion.
Wow.
And they said 87% of the homeowners in foreclosure have positive equity. And
Wow.
there's 151. I think I scored these numbers before a couple months ago, but there's 151,000 foreclosures that were completed in 2021 compared to 2.9 million in 2010. I mean, it's a blip on the, I mean,
Well,
so
we
I mean,
saw
we
that
could,
number that said our foreclosures were at 67%. We jumped all the way up to 147 foreclosures. So
yeah.
it doesn't take that much. Hey, I want to introduce everybody to my new senior analyst. Where is he? There is he. There he is. There he is. That's so. How's the market? What's going up or down, Ringo? I gave him the data. He's just absorbing it. So
Yeah,
just
he's quiet now.
yeah,
He's not, he's a
thinking.
man of few words.
Yes, he's thinking. So he's, he's choking on something. Anyway, I wanted to introduce everybody to our new senior analyst. So he's a kick. He's a rescue. So he's fitting in really good. The smartest dog I've ever had. He's already housebroken. He learns how to walk on a leash without pulling and everything. I know it has nothing to do with real estate, but what the heck, here we are. So
Yeah.
our listings for this weekend, normally, if we're sitting at about 5,900, I expect it to go up to 6,200 tomorrow, which is not very good for a weekend. Normally, historically, every year listings pick up and the buyers come out in force after Super Bowl weekend.
Mm-hmm.
That's just because we have more people here, and so the listings build up, and then away we go. But according to what we're seeing, it doesn't look like that's going to happen this year. So I
I
think it's
know.
going to be a slow march. So if you're a seller, I mean, geez, it's you want to sell, but where do you go? But if you have a destination and you know where you're going, you're either going to downsize or you're moving to another city. It doesn't take much to get your house on the market and get it sold right now.
No, no, exactly. And you know, we talked about that second. I talked about last week that second home pricing differential that's coming out. You know,
Yep.
I thought the lenders would be kind of pulling the trigger around. You know, but there's, you know, probably the first, second week of February, there's already lenders that pulled the trigger already that said we're increasing it as of like today.
Oh wow. Okay, getting the
So
jump on it.
yeah, it's kind of, so we'll see how that, you know, that's going to have, you know, probably, you know, I mean, if you have that type of dramatic effect pricing wise, I think it is going to, you know, demotivate some people from buying a second home. I mean, but still, I think it's not, you know, my gut is it's going to probably, you know, have some effect on people buying a second home. You know, because obviously your rate basically went from say about 3.5 to 4.5. You know, it's going to raise it about a point and a quarter on the interest rate from a cost standpoint. But you know, it remains this. You know, obviously I know why they're doing it, but we'll see if it has. I don't think it's going to have. It'll have some effect, but I don't think it's going to have the effect that the government
I
wants.
don't
Wants
I
it to
don't
have.
think it's going to have the result that they want, which is more homes. And here's one of the reasons why. It's and I know I highlight this and it's hard to see, but since 2014, buyers purchasing their primary residence have made up 70 to 76% of total residential purchases in Maricopa and Pinal County. In Q2 2021, that percentage dipped to 67% and declined to 63% by October. While traditional buyers retreated, remember saying we're reaching that affordability gap, so
Mm-hmm.
the buyers just backed off. Um, Company I buyers came in, and institutional buyers made up of Wall Street backed I buyers, hedge funds, and other investment groups stepped in. Price appreciation slowed from an average of 3.3 per month to 1.1%. So, in other words, as we got buyer fatigue and people were getting priced out, in come the institutional investors going, okay, fine, move out of the way, we'll take them. But the appreciation only went up to 1.1% in October. That number, I think, is going to triple by March
Mm-hmm.
because we're getting into the buying season here and there's nothing there.
No, exactly,
So
exactly. So
sounds like doom and gloom, but I mean, we'll get through it. It's just, I don't know how long this is going to take, and it's interesting. As we sit here and we look at the numbers on a weekly basis, you're just waiting for that 1 week where we're going to go, oh, that's different. And it was actually last week because it went way down lower than I ever thought we would see.
yeah, I think with real estate, I think, you know, 1 week doesn't make a trend, but I think, you know, we would have to see you know, the numbers that we're tracking, we'd have to see, what do you think, 2 months, 3 months, you know, like, okay, there's something going on here, you know.
Yeah, yeah. So, well, look, Pat, you have a
Well, here,
fabulous
there's another,
weekend.
did you
What's
have,
that?
let's see what, Seth, you see Seth?
Oh, let me see here. We got another set. Are you guys seeing examples of people who were pre-approved to buy for an amount when rates were lower, having to adjust what houses they bid on based on the increase in rates?
Nothing yet. I mean, I've been trying to pre-qualify people, um, when it was at 3.25, I put out some pre-quals at like 3.5, 3 and 5/8. I mean, if they're, I didn't have anybody close if you got to be careful with people that are close to debt to income ratio. They're pushing limits, but I haven't, not yet. But I think, you're probably going to see that because there's some deals, 1 out of 10 deals that I price out, let's say, you're like, oh, they are so tight that, they can't have a change in their insurance or they have to be careful. And it's a lot of times it's because due to, what I found out, and I'm trying to tell people this, what people don't understand, you understand this, and I think you've heard me. I don't know if I've said this to you, but I read something and I kind of started formalizing this. My job is basically and I might have said this to you before, you maybe heard, I'm repeating myself, my memory is really bad, but my job is to fit people's lifestyle into the Fannie Mae and Freddie Mac guidelines. And people do not live their life day to day based on those guidelines. And I have to fit that loan into those guidelines. And it's amazing how people just, you know, you have different scenarios that, I maybe have a husband wife where I can't use the wife's income because, she's got a low credit score. So we take her off the loan, but they're tight debt to income ratio wise from a guideline standpoint. But if you add, they know that they can buy a higher price home because I'm not figuring the wife's income into the equation because her score is say a 550. And people don't
Yeah.
understand this. People, like, well, why can't we use my wife's income? Well, I can't put her on the loan because her credit score is 550 or 560. So I think that's where you get kind of you have to fit people's lifestyle into the guidelines. So
you're not seeing too many people getting bumped out of their home purchase yet because of the rate spike. So, but it can happen. So
it's gonna. I mean, it'll happen. One out of 20 people are really tight. It's gonna hurt those fringe players, no doubt about it. So, but it's not gonna have that detrimental effect that's gonna crash this market.
Yeah, not yet. Not yet.
No,
I don't
not
see
yet.
it coming. So, well, look, everybody have a super weekend. Stay healthy, huh?
All righty.
See you, Pat.
All right, buddy. Thanks much. Talk to you soon.